United Parcel Services, or UPS, is alongside with FedEx the biggest multinational shipping and transportation company, without which many smaller businesses would cease to exist. And over the past year, they are down by 17.5%. Now today I want to figure out whether this huge drop in price is rational, or if it's not, and UPS will rise over the next few years and bring its investors great return. Now UPS is a dividend paying company. They currently have a juicy dividend yield of 5% with quite a high trailing free cash flow payout ratio. Now it is quite fun for UPS to have a 65% free cash flow payout ratio, as they don't need to direct a lot of it into innovation. Now moving to the 9-pillar analysis, we can see that the company gets a rating of 7 out of 9, with 2 pillars currently sitting in the red, and that is the 5-year P ratio and the price to free cash flow. Now regarding the P ratio, that is currently actually sitting at only 19.45, which means that the company would be considered undervalued compared to their earnings, and the price to free cash flow is sitting at 21.79, which is decent as well. Now regarding the growth of the company, we can see that the revenue has been growing at 4.53% yearly. They have increasing free cash flow and increasing net income. Now if we have a closer look at these two, we can see that the net income has been fluctuating a little, but it has overall grown since 2019 to the current time, and that is the same case with the free cash flow, fluctuating a little but has grown from 2019 to the current time. So that is the most important thing, the company is growing. Now they also have a decent profit margin of 22.88%, and they have been decreasing their shares outstanding. Now I wouldn't mind them decreasing their shares outstanding a little more aggressively, as they are trading quite cheap compared to their past, but a decrease is a decrease. Now looking at the long-term liabilities over the 5-year free cash flow negative dividends, we see that they generate enough free cash flow to cover all their debt in about 5 years, so that is great. And finally, they have consecutive dividend growth sitting at 12.45% yearly. But if we have a closer look, we can see that that is because of a big jump from 2021 to 2022 of almost 50%. Otherwise, they have been increasing it at a rate of about 5 to 6%. So we have to take that into account. But now let's calculate the company's intrinsic value. So jumping to the Graham's formula, we predict a 5-year earnings per share growth of 13% and get an intrinsic value of $226.25, higher than the current trading price. Now for the next valuation model, we predict a free cash flow growth rate of 11.3%, and plugging in a discount rate at 8.1%, we get an intrinsic value of $226.83. Now when we compare UPS to its competitors, we get an intrinsic value of $133.71, which shows that UPS is slightly undervalued compared to their earnings. And for the dividend discount model, projecting a growth rate of 5% into the future, we get an intrinsic value of $218.30. Now averaging out those four valuations, we get an intrinsic value of $201.27, which is 56% higher than the current trading price. Now UPS is looking very nice. They are a growing company. They are currently very undervalued compared to their earnings and have a very decent dividend yield with decent dividend growth. Now currently the market is experiencing a huge boom in AI and tech companies, which are very often trading extremely expensive compared to their earnings. And then there are companies such as UPS, which have been looked over and are very undervalued with very healthy portfolios. And with that, I hope that you enjoyed the video. Make sure to leave a like and subscribe, as it really helps me out and it's free.